up to be a big expense, and that can be a huge deal. But really, communication, if they're bilingual in certain metropolitan areas, that's also helpful, or multilingual.
Christina, same question.
Oh, sure. This is actually a pet thing of mine. I actually have a system I use specifically to manage my property managers, and I will give it to you guys happily. Monday morning, I send out an email to my property manager. It's got a list of the current projects that are coming up and projects that are just completed. It's a nice, friendly email because they work really freaking hard on your building for not a lot of money sometimes. So you want to treat them well. But this list keeps you guys all on the same page. Almost always they'll reply to you by Wednesday, so Thursday morning I send out my reply to them. It's 2 emails that every week that manages that property manager, that manages whatever properties that they're involved with. Once a month I get their management statement, I sit down and I review it. Right? Do I agree with everything that's happened? I usually, because I'm in constant communication with them, but literally 20 minutes or 30 minutes every 2 days, twice a week, an hour a week. I have a pretty good idea what's going to be on that statement. If I have any questions, I just put it in my next email. I thank them for the work they've done. I try to stay current with them. Every 6 months I evaluate the performance on my properties, make sure I'm happy with the property as part of my portfolio. And it just can lead to a real easy, straightforward relationship. They know you're involved in the property, they know you care about what's happening, and they can kind of count on this sort of stylized interaction without you having to scream and yell. You're pretty much up to date on everything, so there's no really need to scream and yell about things. And it doesn't cost you a lot of time. And to me, it takes what can be something chaotic and makes it quiet. I know when I'm going to do it. They know when I'm going to do it. We'll have good interactions. Unless there's an actual emergency, they pretty much don't need to get a hold of me any faster than Wednesday afternoon and Friday or whatever. So that's my system. I like it.
I could add a couple more things.
Yeah.
Along with the communication line is they have to be really clear with the billing, really good and tight billing. Some complaints that I get from new landlords is that they don't disperse the money on time, which is once a month in California, usually, and they don't have good statements, good owner's statement of cash flows, which we email out every month. So that's a very common issue.
Yeah.
I've seen a lot of people complain because that we're actually moving some people over to our management company right now that the manager refused to provide receipts for the repairs. It's like, how do you refuse? It's amazing to me. I mean, they were talking about the communication and that would being the primary reasons why they wanted to change management companies. And so, those 2 things are huge. Yeah. So, I mean, anything major, I want to see receipts for. I mean, pretty much. I mean, if there's $100, something small, then normally, then I don't get a picture for it, but I'll get a receipt. But if there's something big, we had, one where we had to dig up the sewer line going to the house, and that's a $2,000 expense real easily. And so, yeah, or more. Yeah, and it just depends on the labor cost. I'm in Tennessee, so the labor cost is cheaper. So, but I mean, those are the things that I want to see pictures of the lawn dug up. You know what I mean? I want to see, and I want to see a picture of the house in the lawn too, not just some random lawn. And so when a manager manages 500 units, it's like, yeah, I got a picture for you in my database, no problem. So. I mean, there's a million. It's a cash business, right? So they're going to go pay their guys and things like that. And there's always, being an auditor, you want to second check some of those numbers too. If you have a bunch of expenses to the same vendor constantly, it's like, well, let me go check and let me go talk to that vendor and say, hey, let me see the invoices. What were the materials costs or something like that? Do a little bit of homework, from that vendor particularly, because what if they're getting a cut from the vendor or something? That happens a lot, where they'll get markups on those repairs and get a cut from their vendor. Or, I had a management company which I fired that basically had an in-house renovation company as well. And you think they're not making a killing on me? They had 2 guys working for 2 full days to repair a subflooring in a bathroom the size of these 3 chairs right here. I mean, that was the subflooring. And it's like, it did not take 2 guys 2 full days to do that. 8 hours each day they're billing me for the labor time, and I'm going, that's just, wrong, So, and now I know it takes half that time, So, I mean, there's things like that you want to watch out for, and you want to do those second checks and sampling of your repair items and things like that every once in a while, especially in a new management company you haven't dealt with before. So, you know, all this is experience from getting, you know, losing money. So it happens. So, yeah.
Let's say starting with your first investment, like a guy like me who is looking to buy first investment property that he doesn't live in.
Mm-hmm.
I probably wouldn't go with a management company
Mm-hmm.
because it's just one property, 3 units or something like that.
Mm-hmm.
I guess that's something I have to be just really active in.
Mm-hmm.
I don't know if I have a question.
So how would you
Like balls.
so if you're trying to start out, you know, on your own, especially here in California, read the tenant landlord laws in California. He could probably definitely tell you that, you know, if you don't know the tenant landlord laws in California, you can be majorly screwed. You know, if you don't do everything by the book out here, it's a very, very tenant friendly state.
Right.
And so they can squat in your property for a long time if they don't, if you don't know, you know, if you're not doing everything by the book. You know, in different states, there's different tenant landlord laws, but I mean, you know, the background checks, go talk to a property manager, go talk to another professional like these guys or something to say, well, where should I start? And that starts with your own financial position. What can I buy, or what should I be buying? What reserves should I put aside? And then go from there. You know, versus just, you know, everybody wants a 3-unit. I just analyzed one for my buddy the other day. He's getting a VA loan, 100% financing, but he's getting a loan for $350,000, and is going to make $250 a month. And I'm going, that's just not enough for a $350,000 loan. It just doesn't. And he's going, well, what if I'm fine breaking even because I can pay it off? And I'm like, no, don't break even. You know, don't use a $350,000 loan with 100% financing to make $250. It's just look at your risk levels. You know, all of those types of things. And the only one that's going to be able to tell you about that is someone who's done it before, someone who knows, you know, how to analyze your risk level, because you don't even know your own risk tolerance level just starting out. You know, because you don't know what risks there are in the first place.
Yeah,
So,
I'd even say you're saying you wouldn't hire a property manager. That's probably the property you want to hire the property first
Right.
on.
You learn.
You know, learn stuff like that, because I'll guarantee you that your tenant know the laws and they know what they can get away with. And if you mess up, they're on you. And if the property doesn't pencil with that property management fee, then find another property. It's probably a good way of looking at it.
always.
All right, let's move on. Peter, I'm gonna throw this one at you first. Whenever you take like a new client and you're looking at a portfolio of properties, what are some of the things that you look at when you analyze that portfolio of properties?
Well, I've already talked about cap rates is the big thing I do. That's the first thing I do is I analyze all the cap rates, and then I put them in order. And the lower the cap rate, that's in my order of what I might be selling first if I'm ever going to do it. And then after that, then I'm saying, okay, here's it, the one that has, you know, that maybe the operating income isn't high enough. Then I'll look and say, okay, some of these expenses are out of line, it looks like the rents aren't appropriate, and I'll look at stuff like that. Then the next thing I'll do is I'll look at how are these properties owned. If they don't have an LLC, if they're not owned by an LLC or a limited partnership, I might put that in place to give them some liability protection. Again, it's based upon a person's risk tolerance, you know, how many other assets they have. And then I'll be looking at what are some of the estate planning issues that I could do with these. You know, do I want to, even though they own it all together, do I want to bring in a second family member to own it? So that now if they die, I get discounts in the estate and I can save them a lot of money on estate taxes and issues like that. So those are some of the things I would be looking at as I'm evaluating an existing portfolio. You know, and then, you know, are they overweight? Do they have too much real estate, not enough? I'll also look at somebody's age. If I see they're starting to not be able to manage the properties themselves, is it time to bring in a management company and do some transfers? And then we'll be talking about saying if something has a very, you know, that there's not enough operating income and it has a cap rate that's very low, time to sell and maybe look at getting a higher cap rate, maybe in Tennessee, you know, and do a 1031 exchange and increase your cash flow. Again, it's based upon a person and their background and their current financial situation.
Christina, same question.
It's almost the same answer. First thing I do is I line them up all on a spreadsheet and I get a return on equity. So that this is after the mortgages, so I can see whether or not they're really making money or they get badly leveraged in the property. I then start analyzing the income and the expenses, making sure that those are aligned properly. Are they being poorly managed on either side, or are therefore poorly performing? I then start to look at, well, are they capable of managing this portfolio? Right? Are they literally being able to put enough time into it, or are they working full-time and this is too complicated a portfolio for them, we really need to consolidate it so that they're getting the lifestyle they want in relationship with? What's their goals? How do they want to retire? What are they hoping for out of this portfolio? So I talk to them about what their goals are and whether this portfolio is really going to get them there. Or do they need to start diversifying or changing the portfolio that they've got? And of course, I love the exit strategies. Those are always good, but you know, I honestly, as a young investor, I don't spend as much time on what their exit strategies are going to be. I honestly say, hey, by the time you get there, the laws are going to be different. Hopefully the 1031 exchange will still be there. Hopefully, you know, the charitable gift will still be there. Lifetime annuity will be there. Hopefully those things, those exit strategies will still be there, but you're 25 years away from them. But if they're towards the end, then we need to start positioning now. What is the exit strategy going to be? So everything he said.
I'm not very optimistic.
And I'm older than
Exit strategies are,
yeah.
Yeah, they're gonna.
yeah, primary
Because they
residence,
need your money.
1031 exchange.
They're not mistaken. Matthew, you can get more guys out than Memphis if you gotta send to Graceland. That's the only thing there is there.
You know how tired I am of going to Graceland? I've been there like so many times. No, it's great.
I do a lot of work there.
It is really cool, but at the same time, if you've seen Elvis 50 times, you're like, all right, I almost hate him now. You know, it's enough. You know, but I mean, you know, and it could occur. It's gonna, you know, the tax stuff is gonna occur on a federal and state level.
Yeah.
Granted, California is gonna have more problems than most. But at the same time, I mean, even the federal government's going to have a lot of tax changes and things like that. It really depends on who's going to power and what's going to happen. But over the long run, they need your money, you know, like you said. So there's going to be some changes.
Well, I like that seeing, well, Memphis especially, you have FedEx, you have tax,
I mean, I look at the
income statement.
I look at the rent to price ratios is what I look at when all my stuff. I'm looking at, you know, how much is it going to rent for, how much. You know, how much equity am I getting for any downside risk and things like that. Always look at, you know, that exit strategy from the start. You know, I look at short-term and long-term exit strategies when I'm looking at my investments. You know, so like for example, I'm looking at a multifamily unit right now that's a 9-unit building that I can pick up for around 200 grand, and I know if I wanted to, I could go sell it at a 10 cap for 300 grand. You know, so you know, just. But I'd rather hold it right now because it's going to create a great cash flow. You know, those are the different strategies. But at the same time, you know, out here in California, you can move a property a lot faster. You know, everybody's having a hard time finding the deals in the first place. You're going to move a property real quick, you know, out here if you bought right and did your right homework. So flipping out here is great. Short-term type strategies. Different markets around the country are much better for cash flow. It just depends on the strategy, and always using leverage to get your capital back and things like that. But not too much leverage, you know, because you don't want to put yourself in a bad spot.
Talking of leverage, you talked before about LLCs, liability, and so on and so on. I'm just thinking about if you want to put a real estate into an LLC, how do you get leverage? I mean, how do you get credit to finance? I mean, if you use your own name to buy it, you can already say, what to the bank? Well, I'm just going to transfer this into, you know, how does that work?
Single family homes are going to be real difficult to get financing on unless you're going to private investors, which you're going to pay a much higher rate. But if you're going to commercial, a lot of times they may lend to an LLC, it just depends, but they're still going to personally guarantee you now. You know, it's always going to be the case. So, and they're gonna lend based on the asset, not based on, you know, use so much. They're still going to look at you because they want to make sure that, you know, they have something to go after.
So personal guarantees based on your other assets that are not in an LLC.
Definitely. And they used to do a lot more commercial loans that weren't personal guarantees, but they've obviously stopped a lot of that lately.
The reason why I went the LLC is when your tenants have that troop of Girl Scouts over, and they go stand on the back porch and they all fall, and 13 Girl Scouts miraculously survive, but will require $500,000 of medical care each for the rest of their lives. You don't want that liability to come out and eat up all your other assets. You know, so you know the loan is you know one thing. Okay, you're gonna, if the building goes down, you're gonna have to have personal assets to pay off the loan, but at least you don't lose everything else.
So if you need to borrow $1 million, you need to have $1 million of personal assets to basically.
No, just whatever they decide is enough equity to guarantee the loan.
Cover the loan payment.
Yeah.
And
Well,
it's-
if they're looking at your income and your versus your expenses, they'll certainly look at your, you know, what type of other assets you own. But they're almost more concerned about your ability to
Should
pay the lot.
each property be in its own LLC therefore? Since they are-
Well, it costs you a minimum $800 to have an LLC. So if that's some form of insurance. If each one is in its own, it gives you better protection. I know a lot of my clients will put 3 and 4 together, so if one building goes down, it can take out all 3 that are in the LLC. That way, if one goes down, it doesn't take out all the other buildings. So each one would have their own. It's really your risk tolerance, whether, you know, in a perfect world, yes, LLC for everything, but you gotta weigh that against cost.
And you can't, somebody recommended maybe getting a liability umbrella.
You could do that too, but remember, it could be, you know, those Girl Scouts are gonna easily wipe out your liability umbrella.
It's really looking at that risk tolerance level. I mean,
Yeah.
you know, I usually have a general liability policy on each property, and then on top of that, I have an umbrella policy of like $10 million. You know, that all of my properties are included in, and then I have it in a corp as well, in you know, in an entity as well. But I mean, and you're looking at, I know people too that they own 10 properties in Redondo Beach and just have a gigantic umbrella policy. Because if you go from $10 million to $20 million in an umbrella policy, the difference in premium really isn't that much. If you have a general liability policy on each property too, any attorney or, you know, any CPA is going to tell you, you know, for liability purposes, the safe bet is to put it in the LLC, because then you're protecting all your other assets. But you know, you want to look at that cost benefit, especially here in California, when you got an $800 LLC fee for every single LLC that you own. It can kill you. And don't think that you're going to go put it in a Nevada LLC and get away with the $800. You live here. California wants their money, you know. So, but those are some of the things that take into consideration.
Yeah.
The rules of thumb that I've used in the past is basically anywhere from $300,000 to $500,000 worth of equity, that you can kind of chunk those into pieces. I've also done it by area, like I own some property in Knoxville, Tennessee, and so I chunked those together in LLC. But if you own 3 buildings or 5 buildings, but your total equity in each building is $50,000, you can see how pretty quickly you can say, oh, I'll put 3 buildings together, that's $150,000 sitting, that's my equity sitting in that LLC. And then I always have the general liability policy, and I always have an umbrella that's twice as much as my net worth. So it's my whole net worth, every property that I have, all of my cash, all of my securities, twice as much. So they're always going to go after the insurance policy and not after me. So it's not just twice as much as that particular LLC. But that's the rule of thumb I've used, and it's been sufficient for me. But I mean, I've been taken to small claims court. I've never had 12, you know, Girl Scouts fall off the balcony.
Never had any issues either.
So that's the rule of thumb I've been using.
Cool. All right, moving on. Justin, this one's going to be for you. And we kind of talked about this a little bit. When you're looking at evaluating a tenant and recommending a tenant, I know we mentioned some things like credit score. You know, what other types of things do you look at when evaluating a tenant?
Well, definitely by far, hands down, I mean, can't understate it enough, is FICO score. It's the credit score. And the very common story that we hear is, oh, I've got tons of income. I'm so rich. I'm so rich. I've got tons of money. I'll pay all this money up front. I've got so much cash. I don't care how rich they are, how much income they make. It's all the FICO score, because that's if they pay their bills on time. And we find it's correlated with general upkeep of the property as well. There's other, of course, ratios. Like rent, we do care about income. So even if they have excellent FICO score and like really low income or very little credit history, we also like to see, you know, low income or rent income ratio no greater than 33%. How long they've been at their last residence, or if less than that, the time before that. How long they've been with their employment, what type of work they do. And that's about it. There's a lot of no-nos in tenant selection in California, and of course we abide by all of them. Can't segregate on race, gender, sexual orientation, family status, and religion. I think that's 5. So we don't touch any of those. And that's about it. And then after that, we listen to a lot of soft stuff as well. Because then we get in, if they qualify that, and the manager on our leasing criteria is published, our manager's decision. We have a clause that says manager's consent. or I forgot the exact wording, but it gives us a little bit of gray area in which we listen to how they feel about the property. We want them to really be excited and happy about the property. And you can tell after the showing right away, oh, I've got a lot of concerns, oh, the price, or are you guys going to do this, or are you guys going to do that? Well, you know, sometimes yes, sometimes no. And it's a very subjective and delicate topic, but that's, I think, an important focus for us. If there's a little bit too much, I do get a little nervous, and I'd rather, you know, let's keep thinking about it, and then maybe someone hopefully better will come along.
Justin, when you're talking about, you look at a prospective tenant to see what is their rental history, how long have they been in a, you know, how long have they rented their previous place. So what's a good number to be looking at? Obviously, you don't want somebody every 6 months or every year to be moving, but where's the break point?
Well, there's really none. There's not a simple number, but you want a whole story. 2 years or more is great. If it's less than a year, like, what's going on? That's very uncommon. You're bouncing around. It's risky because we don't want someone to bounce around. We want longer term. Even for our smaller units, a 1 bedroom, 1 bath, we know it's going to be 2 years or so. You know, their family, they're going to grow, get a relationship, move out.
So then does that mean that you tend, and I know this is a tricky
To segregate.
question.
Do we treat them differently?
Do you tend not to rent to younger people?
No, it depends. So certain, the property really determines what type of applicants are applying. 1 bedroom, 1 bath is clearly different than 3 bedroom, 3 bath. You know, a house versus an apartment. And same thing with pets. Like 3 bedroom, 3 bath, we really encourage you to allow pets. 1 bedroom, 1 bath, okay, you can say no pets easier because the population is smaller. But yeah, you look at all that combined. So you get a feel for the risk, which is such a critical word with real estate and investments. Risk tolerance in portfolio and understanding risk is at all different levels, including each and every applicant has a different risk portfolio, if you will, on this 2 sheets of paper.
So does that kind of mean that for a younger applicant, they're probably going to be looking at a 1 bedroom?
Often, it's not common for a single man or woman to rent a 3 bedroom, 3 bath house unless they've got kids that visit on the weekend, but it's just less common.
I also take a look when I'm looking at FICO scores and stuff. Sometimes there's exceptions, like if someone
Right.
had a short sale or a foreclosure,
Right.
or you know, because we just had a huge housing crash, or they lost, you know, there's a bankruptcy, or sometimes like that. Then you consider all the other stuff that you have going, their bank accounts and
For
you know
sure.
their income and stuff like that. You know, because you might have someone that just bought a house in 07 and they just lost everything because they bought it the wrong time, you know, in the market, and then all of a sudden, you know, couldn't afford it anymore or something like that, or lost a job for a period of time and now they're back, you know. So there's issues like that can be exceptions, and each person you want to analyze them, you know, individually. So
Absolutely, I totally agree. So technically, FICO score is not 100% correct because there's case-by-case basis. So oftentimes, you know, we do accept applications from realtors, and sometimes we just get the score, but we want to see all 10, hopefully there's 10, 15 pages of, you know, all the trade lines, all the credit lines, and we look at each one so we could say, look, everything has been paid in full except B of A or Wells Fargo, and we could see that. So, but if we're having a harder time, then we would definitely include short sales and foreclosures if that's the isolated incident that's affecting the score.
let's see.
But if I can, I mean, tenant selection is such. Can I
No,
go on?
please keep going. Tenant selection.
Tenant selection is
one
such
of the
an
most important
important
things. Yeah.
product for an operator at the individual, you know, property versus in a portfolio. Tenant selection is huge because they're part of your team. They really are, and you must, you know, at least, you know, I recommend that you can think about it as a business relationship. They're paying all of your bills, if not a big portion of it. And if any, you know, some landlords we see are so bullish, they give them gifts once a year. You know, thank you for paying my rent, my mortgage, my bills. And then we see others that are really confident. Oh, they asked for this. Well, they've been there 3 years and they want to, you know, to do some sort of maintenance. And sometimes they're really approaching it like, oh, the landlord's abusing or the tenant's abusing my property. That's a very common thing I hear from landlords. We see all kinds of landlords. And I just think that the risk for that landlord to lose financially is higher with that approach, then the risk for the harmonious relationship is clearly much lower, because things happen. Unknown things happen, and then you got a multifamily unit with all these tenants, and then there's flooding underneath the floor plan. You got to get everyone out, put them in hotels, and put them in a hotel for a week while you do all this rehab work. They're pissed. They're pissed, and having the goodwill pays off big dividends when the inevitable happens, which does, just a matter of time.
How do you communicate with those clients, and how often do you typically communicate with your investors on that side?
With the owners, they vary. Some we communicate a lot, some we just like once or twice a year. I know you're saying twice a week. That sounds like a lot.
That's when I know I'm really engaged in my investment. Is because that email, 30 minutes, 2 times a week, is actually a lot of communication for them.
That's a lot.
It's
If
a
you
lot.
have an
The last name
incident,
was Suter, just so I remember.
Huh?
Suter.
Suter.
His last name.
Suter. Yes,
if
Suter.
there's an incident, meaning a maintenance or a vacancy, then we're constant, daily or many times per week is very common if there's an incident. But normally, when it's progressing, normally once, twice a year. Yeah.
Depending on how your deal with the management company is structured, they may actually have an incentive to have a fast turnover if they charge extra fees for finding new tenants. So how can you incentivize the management to actually be very careful in tenant selection and really scrutinizing carefully?
Well, number one, it depends on how many units are in the building. If it's smaller and you want to, you can. A lot of our landlords, we use electronic software, signature software, so we have the owner sign the lease agreement. So they get final approval. We push all the application, the FICO scores, our opinion, and they sign the document, the CAR Form LR, lease agreement in California. Some landlords don't want to, and we do it for them, no problem, of course.
But is there a way you can actually give them an incentive to make sure that they do find good tenants as opposed to, oh, this guy's going to pay our commission, so yeah, you got the place.
Well, that definition of good is very difficult to measure.
Well, better.
Better. So that's up to you, or someone to make a recommendation. Like I would say, if they've got stable employment, stable history, FICO score 750, that's a good tenant.
Yes, sir.
They like
I guess
it.
I was asking, how can I set up a deal with you to make sure that you have an incentive, as opposed to?
Right. So on the property management agreement for California, there's different types of fees, and they're always negotiated individually. One of the earlier questions was, you could go heavy on, some property management companies go heavy on the leasing side and very light on the management side.
Yeah.
So that could be 6% of the lease value for leasing, and then a management fee could be a flat fee of $100 for a single family, or $80 per unit if it's multifamily or something like that. Otherwise, it could be higher, like 6, 7, 8, 9, 10% on the management side, and they give you leasing for free, which I don't recommend, because then generally I believe that property should not be vacant for more than 1 month. It should not be, after make-ready work is done, that's when the clock starts. If it's vacant for a month, your price too high, you're not doing, something's wrong. And so you have to trust that their marketing and advertising is correct, otherwise your price too high.
And one thing that I do, because you get, in the very beginning, we had leasing agents that would go out and help us rent our properties. We ran into the problems of, oh, well, yeah, here's the tenant, yeah, a garbage tenant or
They
something
wash their
like
hands
that.
with it and they turn it over to management.
And so what we did is we went through and we said, look, okay, on our leasing agents, we basically said, look, if we started for specific leasing agents, because we had certain ones, we would hold their commission for 6 months. We wouldn't let them have their commission.
Wow.
Which yeah, that was tough. But at the same time, we've worked with them consistently with those specific tenants, because we are those specific leasing agents. And then for my current management company, we go through and say, look, because he's our in-house guy, that if that tenant moves out within the first 6 months or they don't pay, which typically is a bad screening job. Some things can happen, then they have to release that property for free. They don't get another leasing fee for a tenant that moves out and moves back in, because there's a huge incentive there that, okay, tenant moves out, get my next leasing fee. We usually get so that's kind of an issue there. But we have a special relationship with our leasing agents like that we can consistently do that. But because we're giving them a ton of business, but at the same time, when it's in-house like that, I mean, you can put something like that in the management contract. The manager may not like it, but at the same time, it does set that business relationship up a little bit better. Do you have any feedback on that, or?
Oh,
On the releasing agent, releasing fees of not getting the leasing fee on that? If
I've not
somebody's out.
experienced that.
Okay.
So, see, oh, I'm sorry, go ahead.
Well, I was just going to say, one of the things that I've discovered with management companies is that if they're getting a percentage based upon gross rents, actual rents received, and not the pro forma of what the building should be doing, they're actually incentivized by that to try to keep every unit full, because then that empty unit is bringing down their commission. So they are encouraged to try to, find a quality tenant that isn't going to run out on them and have this turnover all the time. It also has a lot of strain on their office for them to actually, you heard, you can be in contact with some owners twice a year. Well, that's usually because there's some kind of vacancy that shows up. So really the space of running the buildings kind of runs into a pattern, and then they get this vacancy. Now the leasing office has to really pay attention to get that unit ready. They're now in constant communication. Okay, here's the to-do list to prep that unit, and now we got to email it to the owner, and they got to approve it, and then we got to do this. It's a lot of work in their office to try to have an empty unit. So in some ways, they're naturally incentivized to actually not have empty units.
Yeah,
and
sure.
I have a tendency to go, I'd rather pay them 6% on my multi-unit instead of 5%, and do an on-site, thank you to the on-site manager and maybe a little bump here to them, than having a really high leasing fee and a lower management fee. So for me, I've always gone that route. Your management company might say something different.
Yeah.
But, so does that answer some of your question?
Absolutely, that's the solution.
Okay.
From a communication to client perspective, I'm interested in hearing the advisory side of that question. How often do you guys communicate with your clients based on their portfolios?
You're saying their real estate portfolios or all their portfolios?
Well, all their portfolios.
All their portfolios, it really depends upon the client. Most of them, I'm trying to contact them about once a month. Worst case scenario is once a quarter. And that's kind of it. Sometimes I'll have somebody who did just one investment with me, just a one-off, but they've got somebody else really handling all their stuff. So they might be just once a year. But if somebody's active with me and I have most of their assets, minimum once a quarter, always once a month, and some of them it's once a week because they require that much.
Right. Christina, what about you?
Because of my consulting practice, it might be I talk to them sometimes once a day, or because if they're actively in the middle of a purchase, they'll be sending me deals going, hey, I got 45 days to identify these properties, vet these properties for me, Christina. And I'll get an email at 12 o'clock at night going, hey, can you vet this property for me? And I'll try to turn it around in 24, 48 hours for them. But generally, my pattern is I meet with my clients once a month. So generally, I talk to them once a month, and I get some emails in between. And the email is just checking in, or here's what I'm up to, or gee, I did my homework, Christina, here's my answer, whatever it is, whatever it is that they're doing.
Very good. All right, we kind of covered a lot of the other stuff we have here, but we're going to end it on, from our formal questions, this idea of mistakes, obviously we got a range here of people. So Christina, I'll let you take this one. Just from, your own personal portfolio and decisions and clients, if there are some of the biggest, most common mistakes that you've seen, what are they, and what would you recommend people avoid?
Okay. First and foremost, I've already mentioned the one which is the slam dunk. They go, oh man, I'm so excited about this deal, and then they come to me, 6 months later or a year later or whatever it is, and go, it's not doing what it's supposed to do, blah blah blah. And I go, yes, okay, so let's sit down, let's do your return on equity, let's do your, whatever it is. They thought it was a slam dunk, and they just didn't see that it wasn't going to be a slam dunk. So that's often one of the things I see. The other thing that I see a lot is that because it's exciting to be an investor, because it's exciting to leverage your properties, because most of us do it because we like earning the money, or we like the concept of earning that much money, we like a 20% return, we love seeing, is that I get these portfolios that basically are inappropriate portfolios for either the amount of equity they have or the amount of time they have to run it. So they're just not capable of actually managing the portfolio they have. And we need to diversify it or change it into a different portfolio that's actually capable of managing or will actually hit their long-term goals when it comes to their retirement. So it shows up in their experience as a chaotic portfolio. This portfolio requires too much, or my tenants are so shitty, or my management company doesn't work. And it's like, okay, so there's that. And then there's the, gee, I expected this to be passive work, and it's not. You know, I didn't really sign on to be an active investor, and they didn't know that, well, you gotta spend, you know, 3 hours a week or 2 hours a week involved in your portfolio, and you need to not resent that. Because that's what it means to be an investor. If you're gonna make your money work and you wanna have it work well for you, then you do need to give it your time and your focus, at least some of it.
It's funny because I always tell my clients, and I've heard this quote like a million times, but it's like people spend 40 hours a week working and less than an hour a month looking at their own finances and their own, you know, investment portfolios and things like that. It's like it should be the opposite, really, you know?
It could be. Yeah, I mean, I have a client that's earning $100,000 a year in their job or $150,000 a year in their job, and then they've got $3 or $4 million out there in equity, and they're like, I don't have time in my job to pay attention to my $3 or $4 million. I'm like, well, your $3 or $4 million is your retirement account, right? I mean, that's the thing where you're hoping to give up the really stressful job for. So I get it, and I get that it's hard, but if you know, you got to be willing to be intimate with it. You can't just go, oh, I thought all the management company was going to take care of it, or I thought having pure passive deals and nothing but syndicators was going to solve my problem. It's like, no, you actually have to turn over your syndicated deals. You know, if you're going to do hard money loans, they turn over every 7 months, or they turn over every 3 years. You actually have to work to get the next deal out there to turn over your capital and keep it working. So just be willing to do it. Yeah. It's just being willing to do it and put a good system in place.
Peter?
I'm worried about the mistake that a lot of people are going to make, not the ones they've already made. And I think the biggest mistake on the horizon is not planning for inflation. Everybody's gotten afraid. They're trying to get out of the stock market, they're trying to get out of real estate, and they're trying to go into bonds. And bonds are going to get slaughtered when we have inflation. Okay? Real estate is going to scare a lot of people, because when you have your first round of inflation, real estate, in terms of the market price of your property, if you have something that's cash flowing, don't worry about it, okay? Inflation won't hurt you. But the market value is going to get slaughtered, because required rates of return are going to go up with inflation. So all of a sudden, you know, that cap rate maybe that was 4, you know, all of a sudden the required cap rate becomes 8, and you know, it just slams your property down in value. But as long as you've got the cash flow there, you're okay. So I want people to be hard assets, and I want people to avoid gold. Okay, really. I mean, you have a little bit of it, but really, gold has always bought the equivalent of a good man's suit. This is not quite a good man's suit. This is a little bit more casual. Gold is way more valuable than a good man's suit since the time of the Romans. So gold is overvalued now. We probably have another run-up of another 50% maybe, but you won't get out in time when it finally crashes, okay? So think about hedging inflation, and I think that's the big mistake. Silver is taking a pretty good run too, but you know, I don't mind I am 5% in commodities for my clients right now. I like that, and I consider real estate to be an important part of hedge against inflation, and that's why I want cash flow real estate, so you can hold it so you've got the cash flow, okay? Don't want raw land. The riskiest real estate you can do is raw land, you know, if things go bad. So, you know, I've made my mistakes where I've over leveraged and stuff like that, but I like, you know, go ahead.
And by cash flow, you're saying 7% is what you should be looking for?
No. I'm saying whatever it is. I mean, you know, you could have cash flow. You got to make sure that your cash flow covers you. Like, for example, if you're getting commercial and you've got a 7-year fixed, you know, expect when you refinance, you're going to be refinancing at a pretty high rate. So you need a little bit of cash on the sideline, because those, you know, in year 8, inflation will have already slammed us big time. You know, it's there. Inflation's coming, I just don't know when, okay? We're at the end of a credit crunch. When you have a credit crunch, what happens is people start fixing their balance sheets. As a result of fixing their balance sheets, even though the Federal Reserve is pumping all sorts of money into the economy, that money goes to fixing balance sheets and reducing debt, so it does not create inflation. Once we feel good and we say, okay, I've reduced my balance sheet enough, now I've got all this excess cash, are we going to be able to pull it back in time? I say no, we're going to have major inflation coming. And, you know, look at what happened. You know, Nixon put a lot of money in there, and his acts, when he just allowed the Fed to publish money, it took 4 to 5 years before it created inflation. So don't just say, oh, this is what should cause inflation, and it didn't, so it's not coming. It is. So I'm sorry, I probably overtalked that. Sorry. I'm so nervous about it.
No, that's important. Can I jump?
my estimate?
How many years?
I'm thinking, you know, when is this recession going to be over? You know, what's going to happen in Europe and stuff like that is really what the issue is. What I'm really nervous about is maybe this year or next fall, we're going to be watching football. At halftime of the second game, President Obama, who probably will get reelected, you know, that's just a historical perspective, not a political one, is going to come on at the same time that a couple of leaders from Europe are going to come on TV in Europe, and they're going to announce that they're going to devalue the currency big time and just publish a bunch of money, use that money to just reduce a bunch of the debt, and we've devalued, and that way we don't have to have this major tax increase, and Europe's going to have the same thing, because even though Germany's not out there. So I'm figuring this is going to take, you know, that's one action to do it. Otherwise, when the economy comes back, if we do have a recovery, that could be three years away, could be 2 years away. We just don't know. And unfortunately, there's going to be some catalyst that we're not going to be ready for it, and it's going to make your head spin, and all of a sudden we're into, you know, 9% inflation, and then we're saying, okay, that's as bad as it's going to get, and then another catalyst will happen, and we're 15 or 20% inflation. I'm very nervous. It won't happen, it won't last forever, but it's going to be there.
Can I just ask one question on that topic? I've heard that there are a lot of the banks are withholding properties instead of putting them on the market until after the election.
Yes.
Do you believe that's?
There's a shadow inventory. Yeah, go ahead, you should.
No, I'm
Can I
loving
what
it.
does shadow inventory mean?
It means that it's not out there for sale yet. It's still held by the bank, and that they haven't hired a realtor to, you know, sell it.
Right.
Okay.
We've gone through about 3 million properties right now, and there's about 9 million more properties still on the books. So the banks
So do you think
either
after
on the books
election
or
then
have not been
they'll be
foreclosed on
released,
yet.
or-
Okay, I'm happy to take this one.
Go
Peter,
ahead,
I
yeah.
love your conversation. I just want to jump up and down and say, guys, as investors right now, I've never seen the economy be so important in your real estate investment. I talk about the economy every month at my FIBI meeting because you guys want to know what's going on. Because I literally have seen whole portfolios be wiped out because of this downturn, and I have seen people who are stepping into the market now, and I've seen, you know, people garnering and doing amazing things, turning properties over. So I cannot possibly ingrain in you enough as a new investor to watch the frickin' economy because it's going to move on us, and it moves quickly. Shadow inventory, let me answer your question there. For every house that is on the market, there is another house sitting in shadow inventory right now. The banks are artificial, my opinion, okay? My opinion, right? Just watching this for a while. The banks are intentionally withholding the shadow inventory off of the market. This is not something that the government's capable of doing anything about. They have tried to. Obama's done what he can. The Fed's done what they can. Everybody's tried. The banks have gotten together and said, no, we're holding it off the market. They're consciously, falsely controlling the inventory that's available out there, and I believe in order to stabilize the prices. And if you look at Japan, this is similar to what happened in Japan's market when they had the big crash. So, and Japan moved sideways for about 8 to 10 years, okay? Having to do with the shadow market. Now, what the banks are doing right now is they're trying to find other ways to handle that shadow market specifically. They're actually, Fannie and Freddie just offered a package deal of 2,500 properties specifically for large real estate investors to buy up. 85% of those have tenants in them. So they're not going to ever hit the MLS. They're specifically trying to find ways around the MLS. Bank of America, this has just been approved. The Bank of America is going to start taking cash for key or what's that called? Not cash for keys. Basically, you turn the keys over to Bank of America, and they're going to hand you a rental agreement. So you're going to stay inside of your property, and your renter is going to be Bank of America. What are they going to do with those? They're not going to put them in the MLS. They're going to turn them over in bulk and send them to pension funds. So they're actively, what I used to say in my meeting a year ago, wait until 2015, because that's when the next round of the defaults should show up between 2013 and 2015. That's when all of the resets were supposed to show up on the 3- and 5-year arms. But specifically, like there was this big wave and another big wave of all of this sort of aggressive lending. So in 2015, you should have seen a lot of properties on the market, over 500 days time for foreclosure on a property right now. So we're looking at a huge fallout at this long. They're just going to go right, the banks are actively trying to go right around the MLS and control the inventory. So honestly, I think they're going to slowly pace it out. They're going to let the real estate prices stabilize, and they're going to control that market, and they're going to try to go around the MLS in order to not have this huge wash show up. Okay, so that said, deflation, we're looking at a deflationary time. It's not officially a depression because we've not had 3/4 of a negative gross domestic product. It's officially a recession because we only officially had 2. But it is absolutely a balance sheet reset, without a question, which is a version of saying we're in a depressionary market. So once that happens, we're going to see our nature is, and 70% of our gross domestic product is consumer spending. So once all of that happens, then we're going to see the release on the other side. Then we're going to see people pushing up, and we're going to see all of this money that has been flooding into the system. And Europe, which has been in a recession, at some point, Europe and the United States are going to, we're in sync right now. We're all in recession. At some point, we're all going to be moving out of this together. And at that point is when you're going to start seeing really hot markets starting to move. When's that? Well, it's not going to be in the next 5 years. I can tell you that. Will it be in 8 years? Will it be in 10 years or 12 years?
I think with the government is forced to print, they're going to be forced to print money. I mean, the U.S. Federal Reserve as well as the central banks in Europe, so that's just kick inflation to them.
Yeah.
So those of us who are in cash right now, there's no inventory coming, that's what you're saying, so what do you do?
Well, there's going to be some inventory coming because I don't think the bank's going to be able to get rid of all the shadow market the way they want to by going around the MLS. I just think they're going to control it. What it means is that what we've been seeing is that the inventory's been tightening and the actual average value, the national value of a piece of real estate has been going down. Why? Because investors are what's buying. So the bids are keeping it low. But what I'm saying is that you need to be aggressive. If you want, I'm saying, hey, just wait for the next downturn because we're going to see another downturn in 2015. We're not going to see it. Now, as far as I can tell. So go out there now and put out a lot of bids, accept that you're going to buy your property, and you're going to get a relatively good cap rate, especially in some of the middle cities. I mean, LA has always been a place where you're not going to get a good cap rate. The nature of LA has not changed. The nature of New York has not changed. The nature of Moscow has not changed. San Francisco has not changed. All the major cities that have these huge prices.
What are you seeing right now then?
Well, I actually had a client that is putting out 6 to 8 bids a day in Las Vegas. So
I just came back from Vegas.
Exactly.
Just,
and that client says in the last 20 days the market is turned.
Yeah.
Literally, they were there 3 months ago, and in the last 20 days they have not been able to find anything. So that's one place. Another place is Palmdale. I hear people are out there in the Inland Empire as well. So Florida, people are actively. The cities that have been slaughtered is where the investors are starting to bid the prices and shrink the inventory.
And I mean, you can control where you live and where you invest. So I mean, looking at some of and staying on top of the what's going on in the economy is not going and listening to mass media and what's going on in the news. You have to look at specific data-driven websites to be able to find this stuff. Zero Hedge, Dr. Housing Bubble. What's the other ones?
Insider.
Yeah, Business Insider is a good one. There's a ton of them. If you guys,
D-Short.
yeah, D-Short is a great one too.
D-Short, D-S-H-O-R-T. And he compares the 4 mega bears against each other so you get a sense for how this market might move.
Calculated risk, another good one.
Calculated risk, that's a good one.
But by the way, also talking about the economic stuff, there are 2 fantastic FIBI meetings. We've really kind of ended on all this economic information. There are 2 fantastic FIBI meetings on this. Christina's up in Pasadena, which on your sheet is the second Thursday of every month.
Yes,
they talk a lot about this.
Good questions.
And then also, Jeremy Roll runs a group. His is up in Santa Monica. Where's the, well, it says TBA here. It's usually the first Thursday?
First Thursday.
Yeah. First Thursday
If
is
he has it,
usually.
it's the first Thursday. He doesn't have it every first Thursday.
He doesn't every
because
first
travels
Thursday.
for investments.
Yeah.
And we just did a presentation in Long Beach with a couple of economics guys that we videoed, and so that should be up, in the next couple weeks or so.
Oh, we
on
watch that
YouTube.
online?
Yeah, I'm gonna have all this stuff for you guys so that you guys can watch it online and things like that as well. So,
By the way, part of why we take this thing, it's because we're trying to build a channel on YouTube where we can take all the, there's such great information you get from this stuff. Beyond us having some type of record of all this information, we also want to start leaving a trail behind of all this great information. So please, find FIBI on YouTube. Beyond our meeting, Matt's putting his meeting up. We're trying to, so we get other FIBI advisors to put their stuff up. The whole premise of this thing is that it's free education, and it's genuinely about that. So tell other people, and obviously come to the meetings. All right, we're gonna wrap it up. A, we have to get out of the room, and B, the Laker game's on. I know Matt's jonesing to catch the fourth quarter. First of all, thank you. Round of applause for our panelists.